Okay. Good morning, everyone. This is Kribakaran Rajendran, founder of Algo Trading from squareoff.in. We have my friend Vishal Mehta, founder of Market Scanner. So this is another episode of Enhance, where every week we'll be talking about a specific topic related to trading strategies. So in this week, as a part of Enhance, we'll be talking about market regime. So this is one of my favorite topic where I've spent most of my time researching about it. So we'll be focusing on the market regime today, like what is market regime, how to find a suitable strategy for different market conditions, and most importantly, I'll give an example like how market bottom can be quantifiably identified. So people say that bottom cannot be identified, but there is some way that I figured out during the last corona crash. So I'll try to explain that as well. So these are the things that we'll be talking about today. So I hope this will be interesting session today. And if some case people, because this thing that I always listen every single time whenever people get started with trading strategies, what they listen to it is none of a strategy works all the time. So that is why most people say that okay, you should have multiple uncorrelated strategies so that something will work on some period and something will work on the other period. But if someone is having only one strategy, can they able to adapt to different market environments? So that is what we are going to find out today. So what is the market regime? So people who are completely new to this topic, market regime is nothing as such a fancy jargon. It is like just like as I said, so market behaves differently at different times. So over the longer period, market may move up. On the long run, it always moves up, but there will always be certain period where market gets into a bullish phase, market gets into a sideways phase. Again, it can get into a trending phase. So we know that market gets into different phases, but ultimately it is going to go up in the long run. But in order to go from the destination A to B, how does this movement happens? Is it going to be a smooth ride or it's going to be a bumpy ride? So that is what these kind of different periods market goes through, different kind of regimes, different kind of a wave that it goes through is what you call it as market regime. Consider this example. I tried to come up with this example. Hope this will be able to explain in simple terms. Consider this, Vishal. So you are going for a trip, be it a road trip, or I'm going for a road trip from maybe Chennai to Mumbai in a car. So my destination is Chennai to Mumbai.
So when are you coming, by the way?
I'll be coming by car, not flight, no, not any other mode of transportation. Try imagining that you're going in a car from destination A to B. And that there will always be highways, there will always be village roads, multiple roads will be there. It is not going to be a straight highway from the from your home to your destination. Suppose I'm going in a highway, it is a clear path road, right? So it is like I can easily go at a 120-kilometer speed, and there is there is no hiccups that you will have. You can always, once you get into a highway, you can easily go for 120-kilometer speed, and there is no one is going to stop you, or there is no specific no hindrance that you would be getting it. But the thing is, if we are going from destination A to B, there will always be certain intersections, some ways, some path at some time the highways would be closed, and then you have to move to a country road or a village road that will be stretched for a few kilometers. Again, it changed highways. So even though your destination is same, the kind of driving that you do would be different. So you can't go at a 120-kilometer speed at a village road, because it's going to be a single lane. There could be a lorries or big vehicles that can be coming in your way. So you can't go at 120. You have to go at 80, or you have to go at 60. The driving skill has to be changed. You can't overtake a vehicle during those single lanes. And once you get into highway, again, you can get back to the 120-kilometer speed. So that is what this market regime is all about. So market can get into a trending phase, but the moment it turns into a bearish phase, or it starts going down, it can be completely different. So whatever that you have seen prior to the bearish phase, the way it reacts will be completely different, because the people perception towards that gets changed. Because I completely remember during 2007 and 8, if you remember, between 2004 to almost 7 December, it was like whenever the market drops, put in all the money because it is going to go 10x 20x. But that was exactly happened because market moved up phenomenally during 2003 to 2017. Even a stocks like Unitech, it gained more than 15,000% between these 4 years because the people perception towards those bull phases like, okay, I'm going to miss this opportunity, or I don't want to miss this opportunity, I wanted to get in. But after 2008, the perception is like, oh my god, I have lost almost 80% of my capital, or I've lost 50% of my capital, or it will be more worse, like how far or how much more it can go down further. I've already lost so much, I can't hold this losses for prolonged period of time. So these perception changes whenever the market movement changes. So because of that, sometimes market gets into a volatile phase, sometimes market gets into a non-volatile phase. So we'll try to see how we can quantitatively find out what are the different filters one can use to find out which type of market we are in. Accordingly, you can allocate your trading strategies, or accordingly make that as a filter to your existing trading strategy, so that you can't make huge returns, but you can make the the journey comfortable. Just like how I said, when you're traveling in a car from destination A to B, so it's all about how much comfortable you are able to reach that specific destination without getting hurt. So that is what exactly these filters are going to be. So we know that no market goes into different phase, like sideways, I mean bullish, bearish, and sideways. Along with that, the major part that plays is the high volatility and low volatility. So it is not that, okay, it is bullish phase, it is not that it's playing bearish phase. Market can get into a bullish phase, but still it can be under low volatility regime. So it can keep going up. You remember 2017, Vishal?
17. I was about to say that 2070 bullish but low volatility, right?
Exactly. So that is the problem. Excuse me. So when market gets into a different phase, be is bullish or bearish, we can't be so happy about it, because sometimes if you are trading based on a day trading or intraday, it has to be more volatile if you're trading a breakout system. And if you're doing a positional system, it can be a low volatile. If you're an option seller, it can be low volatile. It is going to help you. But we need to find out whether we are in a high volatility regime or low volatility regime. Accordingly, we have to allocate these filters. And only VIX can't help you. You can't simply rely on VIX and see, okay, VIX is at 30 or VIX is at 10, we are at high volume. Even with VIX being at 10, 12, 15, still the market can be volatile. So it is not that if the VIX is below 20, we are in low volatile. If the VIX is above 30, we are in high volatile. So instead of VIX, what I focus on is the ATR.
Okay.
So most people know what they use ATR. ATR is levels. For an example, ATR is, suppose Nifty is trading at 16,000. So if you see these spaces, there is always statistically bear market are a shorter period time zones. So it can't be like 2 years, 3 years, or 4 years of bear market. Bear market is sudden and quick, and eventually it vanishes. So at the max it can be in bearish phase for 18 months, but rest of the periods market is going to hit an all-time high. And those 18 months, or just 4 to 18 months of period, how you react between these 4 to 8 months decides your overall fortune. Like if you are able to sit tight, or if you're able to allocate more, and how you are able to handle these down periods is going to reflect your overall profitability at the end. So these, even consider this 2020 corona crash, nobody would have thought that it is going to go down so quickly and come up so quickly, because it was so sudden. Because it was, market was slowly steadily going up, all of a sudden market dropped 40% in a single month, and within next 2 to 3 months it moved up. Not only it recovered from drawdown, it kept moving up higher and higher. But how many people were able to hold on to their positions during those crash? So when you apply ATR, so what I use is, instead of ATR levels like 200 or 150 for Nifty levels, I use a ATR percentage. So how you can use a ATR percentages? For an example, see this chart. Market moved from 2000 to 16,000.
Okay.
So when the Nifty is trading at 2000 levels, the ATR values would be different. And when it is trading at 16,000 levels, ATR values will be much, much higher. So with respect to ATR, so this is what I wanted to convey. So instead of using a specific level based, we can convert it to a percentage base, and then you apply it to the charts. That is going to give you a perfect, what is actual we are, which period we are in. Because if you are comparing it with 2000 levels and you are comparing it with 16,000 levels, it is always going to be higher, because earlier the
Sure.
ATR can be around 50 or 60 or 70 points. Now the ATR can be around 200 or 300 points. So instead of checking the ATRs and point basis, I always recommend that to check it on percentage basis. So for an example, if you could see this screen, this Excel sheet.
Hmm.
So how do we convert ATR levels
No,
into?
I don't see the screen. Sorry, Kiru.
So let me share that again. New share Excel. Yes. Yeah, you're able to see now?
No, Kiru. Now it is come. Yeah.
Yeah. So fine. So consider this. Say for an example, Bank Nifty is trading at around 35,000 levels, and ATR is around 543. Okay. So compare this ATR with the previous close. So my ATR is 35, I mean 543, and the previous day's close is 35,000. So if I do it in percentage basis, it is going to be 1.5%. So my ATR percentage is 1.5. So always use the ATR in percentage basis. That is going to give you a clear picture on which kind of regimes we are in. For an example,
Sure.
I use a downchain indicator with respect to ATR. For an example, say suppose my ATR, I calculate my ATRs on a daily basis and see whether if I'm in a high volatile period or low volatile period. How do I do that? Is first find out ATR in percentage terms. And the
Sure.
next thing is find out the ATR for the last 5 days, highest high for the last 5 days and lowest low for the last 5 days. So that is going
ATR
to
percentage highest side, percentage highest side and percentage lowest low.
exactly.
Right.
So
Okay. Okay.
so my today is 1.5% and the last 5 days high of ATR percentage is 1.4 and lowest percentage is 1.3. So when it is giving
ठीक
1.5, then I can be sure, okay, currently the market has moved to a high volatile period. And
Sure.
now if I have any specific filters, I can apply this as a filter. Okay, if I'm going to go short only when the ATR is higher than the last 5 days high, and go long if the ATR percentage is lower than the last low. So basically during the low volatile periods, you can initiate only longs. During the high volatile period, you can initiate only shorts, because what happens is when the most of the time during the low volatile phase, it gives you a false breakout. So when it gives a
Sure.
false breakout, most of the shots is not going to work. So that is what happened in 2017. Even that is what happened in this 2021 from May onwards. So whenever it triggers a short, it ends up in a false breakout. So users who's looking for certain filters in their existing strategies, convert the check for an ATR percentage. If you're trading with Nifty or Bank Nifty, check for ATR percentage and find out what is the last highest high and last lowest low for the last 5 days. You can change this parameter to 5, 10, 15. So I'm just taking for 5 because it considers 1 week period. So if you take
Sure.
for 10, it is going to consider for 2 weeks period. So accordingly, you check it out and then you apply it. And based on if it is in the higher band or lower band, I have created this, color code. Like if it is on a lower volatile period, it is going to give me a green color. If it is high volatile period, it is going to give me a red color. So that is just
That's
to give
interesting.
a visual representation. So converting an ATR into a percentage itself is a different thing. That is one thing. And then applying this downchain indicator like highest high or lowest low for the last n bars with respect to ATR, that is going to give you which period you are in, higher periods or lower period. Why this ATR is because even when I was trading in 2017, this golden ratio strategies, it was not working well. So the shorts were meeting with the false breakouts, and there was a continuous prolonged period of drawdowns. So that time when I checked it, I sat and figured it out. Okay, if it is a breakout strategy, the market needs to break and move much higher, or have to move, move much lower. Only then you're going to make profits, right? So when I sat and check, okay, let me check how the market behaved from 2008 to for the last 10 to 12 years. Then if you could see this chart shows the year wise data from 2008 to 2019, And these bars are nothing but the number of days that it moved in those ATR terms. For an example, in 2008, the average ATR level was around 6.8. So Nifty was moving more than 6% on a day-to-day basis, the ATR levels. So almost 120 days, Nifty ATR were more than 6%. But in 2017, almost more than 220 days, the Bank Nifty ATR was trading with the less than 1.5 range, 1.5%
Oh
range.
my God. Okay. Got it.
So out of 200, and you have only 252 trading days. So it is almost 230 days. The market did not move beyond 1.5% on ATR percentage basis. So it was completely narrow range. It was going up on slowly, steadily upward movements, but there was no intraday range, because of which the breakout strategy did not perform well. So these are certain things. When the market changes, you can note down the volatility, or you can note down this ATR percentage, and then you can find out. Then the best example that I would say is when I tweeted this about yesterday. So market regime, who do not know about it, this is a perfect example. So there is chart, it shows a comparison between how a breakout strategy performed prior to weekly expiry and after weekly expiry. So the black box that you see is nothing but how it performed from Monday, Tuesday, Wednesday, Thursday, Friday. So between 2011 to 2016, on every day, the average profit per day is almost same. Monday, Tuesday, Wednesday, Thursday, Friday. It is almost varies between 25 to 45 levels between 2011 to 16. But
so
if
this
you
is what 68 is what? Like I didn't get that part. Sorry, come again. Average
68,
profit.
68 is the average profit per trade. So on Mondays, whenever
68 points. 68 what?
points in Bank Nifty.
And Bank Nifty. Okay, fair enough.
So
Okay.
these are points, average points a Bank Nifty makes on a Monday to Friday basis. So in this case, the orange refers to the points it made between 2017 to 21. The black refers the same profits made between 2011 to 16. So before weekly expiry, after weekly expiry. So the interesting observation is, after the introduction of weekly expiry, so starting from 2017 onwards, the average profit per trade on Thursdays, on expiry days, drastically, significantly reduced to 2, which is almost flat, because market did not make much move on expiry days. So
because of the weekly expiry.
Correct. So because of the weekly expiry, purposefully the index did not move beyond certain points. So because of that, almost most of the breakout strategies couldn't make profits, because there will always be a false breakout. You will see market going down in the afternoon, and eventually it will coming up. If it goes up in the morning, it will come down in the evening.
Trapping all the straddle guys.
Exactly. So they wanted to short all the options. I mean, most of the options, and wanted to make it zero. Because of that, they don't let the index to move beyond certain percentage.
Right.
So this is an apt example of shift in market regime. So if someone has been trading a breakout strategy, so even though we say, okay, eventually market is going to reward you, stick to the strategy, don't make any tweaks, but these things are obvious. So just because of a specific day it is not making profit, we cannot avoid trading a strategy, but we need to find out why it is not making a profit. So the obvious reason is here, this because of weekly expiry playing into picture. So it clearly shows that, okay, this is not going to, reward you if you are following a breakout strategy on expiry days. So shift from, probably instead of trading with futures, you can shift it to option selling on directional basis. So that can be a better alternative way to handle all this part. And the other part is, most of the people, they prefer this 200-day moving average to find out whether we are in bullish phase or in bearish phase. So what happens is, say, be it fund managers or be it in large institutions, most of them, they focus on 200-day moving average. And some people, they try to shift from equity to cash. If the market moves to below 200-day moving averages, they send out a bearish signal, they'll ask their clients to exit the positions. So most people follow this as a filter, but the problem with this filter is 200-day moving average is going to give you a lot of whipsaws. So if you could see it here, so there will always be certain periods market is going to come down and again go up, come down and again go up. So it is going to save you from 2008 and period like 2020, but still in 2012, 15, 16, those periods, whenever market went down and went up, multiple times it is going to keep you out of the markets if you wanted to move to cash. So instead of 200-day moving average, the better solution would be apply a 10-month moving average on a monthly chart. So it's 10 MA is much better. So 200-day moving average is completely different from 10 months. So 200 days is almost 10 months, but you are applying the 200 on a daily chart. So when you're applying it on a daily chart, it is going to give you a lot of noises. But when you're applying the 10-month moving average on a monthly chart, you could see, there's very less whipsaws. So people who wanted to move to cash, okay, so I'm having a specific strategy, and say suppose a long only portfolio guys who hold stocks, but they do not know when to exit. They can use this 10 MA into an index and see whenever index goes below 10 MA, I'll just close all the stocks and sit in sidelines because I am not able to handle the bigger drawdowns. So people, if they did that, they would have been out by March 2008. So maximum damage would have been avoided. So by 2008 March, they would have been out. And again by April 2009, they'll be in. So you're not completely missing the opportunity. You are coming out when the market goes into up or down phase. And again, you are getting in once you see that the market is coming back above the 10 MA moving average. The same thing happened
But Kiru, this will also come with a little bit of higher risk because somebody is waiting for the end of the month, and say in a March fall, obviously we will see the closing as on this that we got out. Obviously it removes the whipsaws, but it also can have a higher drawdowns, right? Is my understanding correct? It's a payoff.
So that is the, so it's not that it's going to be, the 200-day moving average is going to give you a lot of whipsaws, but 10 MA can give you reduced whipsaws, but this is on a monthly chart. As you said,
you
when
have to
you
wait
are
till then.
holding on a monthly chart, it is obviously going to give you a bit of panic. We have to wait till the end of the month, but that is going to help you many times because you are not going to get in and get out multiple times.
Maybe something of this, I don't know, we haven't backtested, so we can say maybe find a solution which is in between, say just below 10 MA by a certain percentage. If it falls, then the chance of recoveries are very less. So maybe something between the two.
Yeah, I have a parameter for that also. Let me explain that parameter. So this is
okay, you already had it. Okay.
So this is a bullish bearish indicator that I have created based on this same 10 MA part. So this green line and red line is nothing but how far the moving average is from the index. For an example, if you see at the peak of 2008, January market was trading at around 6,500 levels, but the moving average was around almost 800 points away. So it is much higher. The moving average is here, but the market is here. So market is extremely bullish. And if the market goes down and if it goes below 10 MA, it is going to change into a red color, or it's going to give you a bearish signal. So what one can do is, for an example, this is the bullish and the bearish phase indicators. Say suppose Nifty is at 6,500 and the 10 MA moving average was around 5,500. So what you have to do is find out the difference between these two. So it is 1,000 points. Divide this 1,000 points with the 10 MA. So it is going to give you 18.2%, which means that market is trading almost 18% above the 10 MA moving average. So market is extremely bullish. So what you can do is, so you just have to calculate this on a specific close to place basis and see how far or how close it is. Say if the market is almost near 5,800, so it means that only there is a 5% difference. And if the market goes down below this moving average, and if it trades, say suppose 4,500 or even 3,200, so these percentage basis will be lot less. So almost it went down 40% from its previous moving average. So when you apply these kind of quantitative parameters with the moving average, then that is going to give you how far or how near it is to the moving average, and accordingly you can make a decision out of it. So you can apply it to your long-term holdings, or you can apply to any specific stocks, and then see how far or how near this specific moving average is, and accordingly you can make a decision out of it. That is going to just give you a signal whether the market is changing the regimes or not. So that is what I wanted to convey. And this is the last slide. So this is some interesting part that I did. So we can market bottom can be really identified through quantitative process. What do you think, Vishal? Can the market bottom be identified?
So yes, I think so. It can be identified because I'll go back to a guy called William O'Neill, who has kind of built a model of looking at major of the market bottoms and found certain characteristics. And
Okay.
they he called it as an follow through day, and the volume should be greater than, and if the market moves more than 2% from the
Okay.
bottom, and then there is a process. But yes, it can be done. Difficult one, but not fully quantified. It's like 95% is quantified, still that 5% is there. But yes, I believe that it can be quantified.
Right, right. So what I did is, during the last periods of crash, I wanted to study the VIX, India VIX.
Okay.
So, but the problem is India VIX started in the year 2009, I think 9, 10. From that period only it started. So we do not
Hmm.
have a VIX when the market crashed in 2008. So I went
Sure.
and studied US VIX. So the
Okay.
US volatility index, they have
Sure.
20 years of data from 2000 onwards, from 2000 to
Sure.
2020,
Sure.
almost 20 years of data. I studied
Sure.
their VIX. So
Mm-hmm.
I found an interesting observation there. So what happened
Mm-hmm.
is during the dot-com crash and during this 2002 end crash, the VIX shot up almost 30,
Mm-hmm.
40 points from the 40 levels. Then it went down 45%. So it almost crashed 50% from its peak. So we know
Right.
volatility index moves up when there is an extreme fear. And once the
Sure.
fear resides, it comes down. So whenever there is an extreme panic in the market, VIX moves up. But
Mm-hmm.
when the 50% is dropping from its peak, which means that half of the fear is gone among the
Mm-hmm.
investors. Same thing happened in 2008. After the VIX shot up during the Lehman crisis period and during this October period, by December, VIX almost no shot, went down 50%, more than 50%, 58%. And the same thing
Mm-hmm.
happened in 2020. By
Mm-hmm.
April, VIX crashed almost 50%. So all these three
Mm-hmm.
different phases, market crash. I mean, VIX crashed. Market did not move up suddenly. Market was staying
Mm-hmm.
calm and slowly. It
There.
was just being in a sideways. But VIX crashed instantly after all these periods. Then when I checked
Mm-hmm.
the respective chart in Indian markets, exactly when the VIX crashed in 2002 end, that is exactly when market bottomed out with respect, in Indian markets. Most of the world markets bottomed out. Even Indian markets bottomed out there. From 1,000, it went to 6,000 levels in the next 3 or 4 years after that
Mm-hmm.
period. And again, when the VIX crashed in the 2008, around October to December period, it crashed more than 50%. Then when I checked the 2008 chart, then I could see exactly during those period, during the October, December period, market bottomed out. It did not go down
Mm-hmm.
further. And
Mm-hmm.
again, when I checked the Indian VIX, because after the market bottomed out in 2008, it moved up
Mm-hmm.
fantastically. So from 2008 to 2020, it was pakka clear uptrend. And then
Pakka
in
clear
2000,
up trend.
again in 2020, same thing happened with
Mm-hmm.
India VIX. I moved to India VIX. Then in 2020, I could see,
Mm-hmm.
okay, VIX moved up to 85 and now it is 40. By
Mm-hmm.
April itself, it was at 40 levels. So it
Yep.
almost crashed more than 50%. Then if I have to go by the previous theory, then this is going to be the bottom. Definitely we are
Mm-hmm.
bottomed out. And that was the exact period we were at the extreme panic. Like, everybody, everywhere, it was complete of negative news. But I
Sure.
was so confident that this is going to give you profits. Then I written a detailed article in the blog itself. Okay, is the stock market bottomed out? Then I explain
Mm-hmm.
all these factors, and then this is what it is going to happen, because we do not have a VIX in 2008, but based comparing with the US markets, we could see market
Mm-hmm.
has bottomed out. So this is a good
Sure.
period to buy. And even that was a
Yeah.
period I started my long-term investments also. I bought companies like Kotak Mahindra. I bought
Right.
companies like, National Aluminium for 20 rupees, 28 rupees, Divis Lab for
My
1,700 rupees.
God.
All these companies, I do not wanted to take a risk with small caps or large cap, but these are
Sure.
much big companies available at a greater price. If my
Sure.
theory is going to be right, I thought, okay, let me buy it. And immediately I bought all these companies. And
Right.
eventually we know what happened. All these companies moved up more than 100% in the next few months.
True.
That gave me a clear picture, because even though we don't have a data, comparing with the US data, we could come up with a clear indication. Okay, so you can't exactly buy at the bottommost price, but
Bottom.
somehow it can give you a much earlier entry than the other
Mm.
parts. So that is what I wanted to convey with regards to
So
bottom fishing.
I think so. It's a brilliant point that you moved about talked about the VIX. There is another thing that you may want to experiment with it. I haven't done it, to be honest, but you since you are looking in the VIX, so Larry Williams, he's supposed to be one of the legendary trader. He came out with a concept, or let's call it William VIX fix. Okay, so
Yes,
basically
Wix Fix.
wherever.
Yes. I remember.
Yeah.
I think I've already done that, man. Wix Fix. I even created an AFL for that, I think.
Indicators. Yeah,
Yes,
so maybe wherever the VIX data is not available, but what he has been able to kind of replicate, although it is completely different methodology, it has nothing to do with the options. It's
right.
just basically the gear, what do you call it, as the greed and fear, and mainly on fear. So that VIX fix, when he plotted with VIX of US, it was almost 95% correlation, 90 to 95% correlation. So maybe
Right.
that can be used for us as an what do you call it, like an pseudo
Right.
VIX, if we don't think that the VIX is there. But I think so the volatility regime is kind of explanation. So I have a few questions, Kiru, here as an investor, because I am a believer that I cannot predict the regime. So
Right.
regime is good to know, but then how do I modify my strategy or add strategies or delete strategies? Or because historically it can be done, what about future going forward? Like, how would I know that now we are going into a low VIX regime, and by the time I get to know, maybe low VIX regime is over and then we are on the high VIX regime? So how do we play that right?
Exactly. So what they call it as like, no, this regime shift is just like going to a party without having an invitation. You go to a party and they do not give you a start time or end time. But if you
Right.
go too soon, you will be very bored because nobody will be there. And if you go too late, party would have been already
It's
ended.
over.
The fun would have been already gone. So exactly
Right.
this market regime is also like that. So you cannot go much earlier also, or you cannot go much later also, but it's better to be prepared and apply those filters much before. Say for an example, those ATR percentage basis or the last high and low, those kind of parameters, you can apply it to your existing trading strategies and change your risk exposure. Probably if I'm risking 2% per trade when the volatility is high, I'll be risking only 0.5% when the volatility, when the ATR band comes to the lower values. So I'm not going to switch off the strategies, but I'm going to reduce the exposure. So let me run the
Sure.
same strategies across all different markets, but change my exposure between these time frames. So whenever the volatility is in my favor, which is going to be in favor of breakout strategies, increase the exposure. If the volatility is not in my favor, for an example, this year, when the VIX is going low and the ATR is going low, no big range after March or May, my risk per trade has been reduced. So by increasing or decreasing your risk per trade based on these ATR bands, that is going to help you to sail through these rough phases or good phases.
Okay. But when do you see the regime filters? Like, do you do it weekly, monthly, quarterly? When do you kind of keep a
It
track
depends
of
upon
it?
your look back period. So for an example, if I'm an intraday trader and if I'm an investor, I cannot have a look back period on a days if I'm an investor. If I'm an investor, it should be in a month's basis. So in that
Sure.
month's basis, I can just use this 10 MA percentage basis, how far my specific stocks or indexes far from this 10 MA moving average. If I'm a day trader, then I can use a daily basis, like on last 1 week, what is the volatility in last 1 week, what is the ATR, accordingly I can take the decisions for my day trading strategy. So your look back periods has to change with respect to investing or with respect to positional trading. If it is a positional trading, it should be at least for 2 weeks. If it is day
Okay.
trading, at least for the last 5 days. So 5 days or 2 weeks, and then it is on a monthly basis. Once you have this different look back periods for different types of strategies, then that is going to help you out.
Awesome. Awesome. No, I think so. I have exhausted with the question, but this was a very useful, kind of session, Kiru, because I think so. We all talk about strategies day in, day out, but
Right.
when to increase your exposure and decrease your exposure is the most important thing. And I think so that I have taken with me, and I'm sure the viewers would have taken with them also. So yeah, next week we will come out with a new enhanced session with a new topic, and we request you to put out all your comments on the YouTube sections or on Twitter and share it, so we can actually start working on those themes and we get time to prepare them and present to you.
Sure. Definitely.
Yeah.
No, I request the same from the user side. So hope people find this session helpful. And if you guys have any specific questions that in case we shall forget to ask, you can put that in the questions, comment section. We'll try to address those questions. So
Sure.
next week it's Vishal's side. So if the ball is on the Vishal's court, so he has to come up with
Yeah.
other topic the next week.
Awesome. I would definitely, for sure.
Okay, Vishal. See you, Vishal.
Okay.
Bye
See you.
bye.
Bye.